Last week, the Feds held their third meeting of the year in which they decided to hold interest rates where they currently are at 5.3%. Although the market had been hoping that this would finally be the meeting we get to see interest rates get cut, Jerome Powell stated that it was still too early to start cutting rates due to inflation still being stubbornly high. Central bankers reiterated during the meeting that they still needed greater confidence that inflation was coming down before they actually start reducing interest rates. As we await the Federal Reserve to start reducing interest rates, it's resulted in several asset classes that are known for paying higher dividends still offering above average yields. Two of which I'll discuss today offer, in my opinion, a reasonable risk-reward trade-off. I recently bought very small amounts of the following holdings, and I'm going to discuss why I did so, despite both of them coming with an above-average risk. Anytime you come across an investment yielding this much, you should recognize that it's a good indicator that there's an above-average amount of risk involved. Also, my portfolio currently has over 30 different holdings in it, so I'm well diversified just in case one of these holdings does go through a dividend cut. So keep that in mind before considering these investments for yourself if you are a more risk-averse investor. But with that being said, let's go ahead and get started. The first stock I just recently bought more shares of is Arbor Realty Trust, ticker symbol ABR. Arbor Realty Trust is a company that specializes in loan origination and loan servicing. They provide floating rate bridge loans to real estate owners, developers, and investors. The purpose of these loans is so that property owners and developers can move ahead with the purchase of a property or renovate a property while they work out the terms of securing permanent, longer-term financing. Issuers of bridge loans are able to charge much higher interest rates than average, and they're usually backed by some sort of collateral, which does make these pretty profitable investments. This company's stock has been battered for more than 2 years, and if you know anything about the state of the market, you'll know why. As a result of higher interest rates, these kinds of businesses have been under a lot more pressure for a while. This company is structured as a mortgage REIT, but they aren't like the typical mortgage REIT that exists. This company focuses on issuing their own loans as opposed to investing in already existing loans, which is what the majority of MREITs out there do, including Annaly Capital, AG&C, and all the large players in this sector. The biggest source of revenue for ABR is providing bridge loans to apartments and multifamily properties, either for new construction, renovation, or just acquiring them. Although the housing market has been under a lot of pressure for a while, the same has not been true when it comes to the multifamily sector. New apartment construction last year was at an all-time high according to estimates. This resulted in still a lot of companies seeking bridge loans, which Arbor benefited from. So although this was good news, higher interest rates have appeared to have resulted in decreasing demand as the multifamily sector appears to be cooling off this year. Not to mention, Arbor Realty has been under several attacks by short sellers, including Ninja Research and Viceroy. I've been covering the drama going on with these short sellers since they first started, and today ABR is still a very highly shorted stock in the market. In fact, as I'm currently making this right now, Arbor Realty just came under attack again with new allegations. I might have to make a follow-up video going deeper into the state of this company and the new allegations against them. This company really did have an incredible history of dividend growth, especially for a mortgage REIT. They increased their dividends every single quarter for almost 5 years straight, and they grew their dividends at least once a year for nearly a decade. It's for this reason that ABR has always been in a league of their own, as this kind of dividend growth is unmatched by any other mortgage REIT out there. However, given the more challenging environment in the market, they did put a pause on the dividend growth, so now they've been paying 43 cents per quarter for a year now. This still currently gives ABR a dividend yield of roughly 13.34%. So taking into account the more challenging environment going on for them, let's take a look at their most recent financial results, which were just released last week. In the first quarter of 2024, Arbor Realty reported distributable earnings of 47 cents per share, or 48 cents per diluted common share, excluding a $1.6 million realized loan on a non-performing loan that was previously reserved for. So they had one loan in their portfolio that they knew they were going to have to deal with. Their dividend payout ratio is currently at 91%, which is pretty average for a mortgage REIT, but it's much higher for this company in particular. ABR historically has had one of the lowest payout ratios among mortgage REITs, usually between 70 and 80%. They currently have over $800 million in cash on their balance sheet, and last month they repurchased $11.4 million worth of common stock. This is usually a pretty good sign of confidence. A company board will decide to do something like this if they're really confident that their stock is currently trading at a sizable discount. In general, if the board members or the company themselves are buying their own stock, that's usually a good indicator that they know that they're doing much better than the market's giving them credit for. So in the end, while this company is still going through a very difficult season, they're still posting earnings that are good and they're still covering their dividend, and their share buybacks are another good sign. I recently bought just another small number of ABR shares. Not too much, but I am going to bet that things will get better for them later this year. The second holding I continue to buy despite the negative feedback and press surrounding it is the PIMCO Dynamic Income Fund, ticker PDI. This closed-end mutual fund invests in fixed income markets around the world. PDI normally invests in a portfolio of debt obligations and other income-producing securities of any type, with varying maturities and related derivative instruments. This fund's investment universe includes mortgage-backed securities, investment-grade and high-yield corporate bonds, developed and emerging market corporates, and sovereign bonds, as well as other income-producing securities and related derivative instruments. This fund normally invests 25% of its total assets in privately issued mortgage-backed securities and 40% of its total assets in securities of issuers economically tied to emerging market countries. If we look at a breakdown of this fund's holdings, we can see that its largest section is going to be mortgage-related investments at 25%, followed by high-yield credit bonds at 24%, and investments in non-US developed company debt at 13%. So PDI does hold some pretty risky investments, although it is a diversified fund, which does protect it a little, but it's still full of risky holdings. As far back as 2017, from what I could find, people were predicting that PDI was going to cut its dividend. Despite all the occasional reports and analysis from websites like Seeking Alpha and The Motley Fool, this closed-end fund continues to hold up and pay its normal monthly dividend. But honestly, I do understand the concern. I recently went in depth on the holdings in this fund, and to be honest, I had to come to the conclusion that a lot of what's inside this fund is really like a black box. It has a lot of investments that are extremely, if not impossible, to do your own analysis on. Many of these companies and funds don't publicly release information on them. Not to mention, it does hold a lot of foreign securities, which only makes researching them even more difficult. PDI is becoming what I'd probably consider to be a zombie fund. These are closed-end funds that, despite holding risky assets and reporting sizable amounts of return of capital, have never gone through a serious dividend cut. There's a handful of other PIMCO funds that are like this, but I think one of the best examples out there would have to be the Guggenheim Strategic Opportunity Fund, ticker GOF. Despite reporting extremely high amounts of return of capital, GOF has not once ever cut their dividend. Somehow, some way, Guggenheim has just been able to provide the exact same monthly dividend amount for the past 11 years, and it's not easy to understand how they've been able to do this. As I've kept saying about these PIMCO funds, because they hold fixed assets, these investments fall in value when interest rates rise. That explains the share price fall of PDI back when we first started seeing interest rates get increased. Once the Fed start reducing rates, then there should be growth in store for its NAV. But despite rates not being cut yet, this fund is still up almost 10% for the year in share price. But with that being said, those are two investments I recently bought more shares of that are still yielding over 13%. I'd encourage everyone to do their own research and reach their own conclusion as to how safe these investments are. Dedicating a small percentage of your portfolio to these holdings might be worth considering though for you. Just for the sake of transparency, even with my most recent purchases, ABR currently makes up only 2.5% of my investment portfolio, and PDI only makes up 3.19%. So you can see that if you have a portfolio that's as well diversified as mine, if a holding in your portfolio, which is 2.5% of everything you own, goes through a 20% dividend cut, that's not going to be a substantial amount of dividend income lost. That's why I don't mind purchasing more of these holdings, but like I said, I do think that there is a risk-reward trade-off here that is appealing. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher-yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.